You think the economy is getting better just because you see some green numbers on your phone screen, right? Let me tell you something. You are being completely played. You are secretly getting poorer every single day while a tiny group of people are getting obscenely rich. Before we dive into the exact data of how this wealth redistribution is happening right now in SCHD, I need you to drop a comment below right now with your current age and the exact amount of money you manage to save or invest every single month. Seriously, type it out right now. Because your age and your current monthly investment rate will completely determine whether you survive the next years of economic chaos or whether you get absolutely wiped out by inflation and hidden taxes. The last time the world saw a structural shift, this massive, most ordinary people completely missed the boat, and the few individuals who actually paid attention and stayed disciplined became multimillionaires. Right now, in SCHD, we are witnessing a terrifying collision of macroeconomic forces that have never, ever occurred at the exact same time in modern history. We are talking about the stock market, gold, global trade policy, artificial intelligence, and the global reserve status of the US dollar, all moving in ways that university economics textbooks do not even have a chapter for yet. Most people are entirely asleep at the wheel. They are reacting emotionally to sensationalized news headlines. They see a red day in the market, and they feel sick to their stomach. They see a green day, and they feel like financial geniuses. That is the exact definition of a retail sucker. That is how you get harvested by Wall Street like ripe jyotsai. Today, we are cutting out all the mainstream media fluff. We are focusing strictly on the brutal facts, the cold data, and the exact step-by-step strategy you need to deploy with your own capital right now. So make sure you lock in and watch until the absolute end. Let us start with the raw reality of the stock market. On January SCHD, the SP Woodinian crossed T10 points for the first time in human history. Let that number sink in for a second. T10, this is an index that took nearly 10 full years to grind its way from C10 to Wu10. Then it exploded from Wu10 to Liu10 in just Jomaus Hort months. And then it catapulted from Liu10 to T10 in only Shasimi aunts. The sheer velocity of this capital expansion is something the world has genuinely never seen before. But here is the catch. This historic milestone of T10 is not a victory celebration for the average person. In fact, for most people watching this right now, that number means absolutely nothing because you do not own enough assets to benefit from it. If you are sitting on cash in a traditional bank account earning a miserable Bifenzadinderni interest, you are losing the game. You are watching the value of your labor melt away while asset owners watch their net worth skyrocket. We are not just living through a standard cyclical bull market, we are living through a massive historical transition, and the next 2 to 3 years of your life will be completely dictated by the structural decisions you make right now. Let us break this down piece by piece into part 1, which is the massive AI machine and what it is actually doing to corporate earnings. That spectacular market breakout on January SCHD was not some speculative bubble based on internet hype. It happened because artificial intelligence has transitioned from a futuristic tech demo into a massive cash-generating commercial reality. Look at the audited corporate data. Right before the T10 breakthrough, Microsoft officially reported an astronomical $40 billion backlog in AI-related enterprise service contracts. These are not vague projections or future wishes. These are legally binding corporate contracts with institutional money locked in. Then Meta announced they are deploying more than $1 billion in SCHD alone strictly on building out their AI computational infrastructure. The 4 undisputed titans of the technology world, Alphabet, Amazon, Meta, and Microsoft are collectively on track to spend an unprecedented $1 billion on AI hardware and data centers just this year. Think about the sheer scale of that capital expenditure. That $1 billion is not vanishing into thin air. It flows directly into the balance sheets of the companies building the physical machinery of the future. It flows into semiconductors, advanced cooling systems, and specialized infrastructure. That is why NVIDIA effortlessly crossed a $1 trillion market capitalization. That is why companies like Broadcom, Micron, and ASML are experiencing historic, unprecedented demand. This is an industrial spending supercycle, unlike anything we have witnessed since the national highway system was constructed in the RCTH century, except this time it is happening across a span of mere years instead of multiple decades. Goldman Sachs has already aggressively raised its year-end SCHD target for the SP Woodinian to T10, while JP Morgan has published a realistic bull case scenario pointing directly to bottom points if macroeconomic conditions align perfectly. But do not let these massive aggregate numbers blind you. The SP Wubaisaushi Iding T10 does not mean the entire economy is healthy. It does not mean your personal capital is automatically safe. Just because the broad index is up, right now we are trapped in a deeply bifurcated split market. On one side you have tech AI and semiconductors literally printing mountains of cash. On the other side you have traditional healthcare corporations getting absolutely crushed, legacy consumer brands dealing with severe structural headwinds, and commercial real estate firms desperately struggling to refinance their massive debt loads. Look at the corporate casualties. Nike recently experienced over a $1 billion direct headwind from global trade disruptions. Procter & Gamble was forced to aggressively raise retail prices on Bifenja of its entire product catalog due to a $1 billion annual cost impact. United Health stock suffered a catastrophic drop of nearly Bifenja in a single trading session. So when you look at the broad index going up, you need to understand that the index is no longer representative of the average business. The top 7 tech stocks now command nearly 50% of the total weight of the SP 500. This is the highest level of market concentration we have seen in modern financial history. You are not investing in the American economy when you buy a standard index fund. You are primarily investing in a hyper-concentrated basket of 7 mega-cap technology monopolies. Meanwhile, out on Main Street, the real economy looks radically different. Consumer confidence is under severe pressure. Middle-income families shopping at Target are purchasing significantly smaller baskets of goods. Walmart is issuing highly cautious, defensive guidance about a deeply murky, uncertain consumer environment. Real GDP growth in the first quarter of SCHD is trending down toward a modest 5%, which is a massive deceleration from the fiscal spending-fueled peaks of SCHD and SCHD. So you have this bizarre parallel reality where the stock market continuously notches fresh all-time highs, while ordinary people feel an intense financial squeeze in their daily lives. Both of these realities are completely true at the exact same time. And this is exactly what an economy looks like when corporate capital gains are intensely concentrated in specific technological nodes, while everyday wages fail to keep pace with the structural cost of living. Now let us transition to part 2, which is the global trade war that almost nobody truly understands. The shifting landscape of international trade policy has become the most disruptive economic force since The Independent Tax Foundation recently estimated that current international trade policies amount to an effective average tax increase of $10 per single U.S. household in SCHD alone. Just a couple of years ago, that estimated domestic impact was only $10. Now it has climbed to $10, and the trajectory is moving steadily upward. Then on February an absolute bombshell dropped. The U.S. Supreme Court issued a major ruling declaring that the International Emergency Economic Powers Act, which was the foundational legal tool used to unilaterally impose broad-sweeping tariffs on global trading partners, does not actually grant the executive branch the constitutional authority to levy broad import taxes. This historic ruling instantly reshaped the entire international trade landscape. The sweeping broad tariffs fell overnight, leaving only the specialized section R tariffs, which specifically cover industrial sectors like domestic steel and aluminum, fully intact. Now, does this mean the international trade friction is magically resolved? Absolutely not. The executive branch responded almost immediately by implementing a Bifenja universal tariff using alternative, complex legal mechanisms, but the landmark Supreme Court ruling effectively dismantled the most aggressive, unrestricted pieces of the previous tariff framework, creating a highly volatile corporate environment. Meanwhile, major trading partners like China have retaliated aggressively, implementing targeted Bifenja tariffs of their own along with strict strategic export controls on critical raw materials. These measures are specifically engineered to place immense operational pressure on American manufacturing corporations that remain deeply dependent on international supply chains. International trade tensions are not a temporary phase. They are a permanent structural shift. Tariffs on imported pharmaceutical components are projected to potentially hit a staggering Bifenja by late SCHD, while consumer electronics remain caught in a highly complex legal and regulatory gray zone. What does this mean for you as an investor? It means giant, multinational corporations like General Motors, Ford, and Toyota are being forced to completely upend their global logistics. They are aggressively reshoring, moving their heavy production facilities back inside the United States to completely avoid these massive border costs. General Motors paid a staggering $1 billion in direct tariff costs in Naotening Arshawu alone. Toyota and Honda have both announced massive multi-billion-dollar capital expenditure plans to rapidly expand their domestic U.S.-based manufacturing footprint. This is a massive, slow, and incredibly expensive structural unwinding of globalized manufacturing that will take multiple years to fully complete. And during these transition years, corporations are experiencing massive operational friction, soaring input costs, and intense earnings uncertainty. Look at what the monetary authorities are doing in response. The Federal Reserve cut interest rates 3 consecutive times in late Ardenarwu, systematically dragging the benchmark federal funds rate down to a range between 5% and 5%. And institutional markets are aggressively pricing in even more interest rate cuts throughout the remainder of Ardenarwu. Lower interest rates significantly reduce the cost of corporate borrowing, acting as direct financial fuel for business investment and stock buybacks. But at the exact same time, trade disruptions are pushing the physical cost of consumer goods steadily upward. So you have this intense macroeconomic tug of war. On one hand, the Federal Reserve is actively injecting liquidity into the financial system to support economic growth, while on the other hand, trade policies are making the real world structurally more expensive. Navigating this exact friction is one of the greatest intellectual challenges for any investor trying to deploy capital today. This brings us directly to part 3, which is the gold story that almost nobody is paying enough attention to, while everyone is staring at technology stocks. Gold has been quietly executing a historic move that defies decades of traditional financial patterns. Let us look directly at the verified numbers. Gold closed out the prior year up a spectacular 5% in a single 12-month period. The last time the global gold market displayed that level of raw upward momentum was all the way back in Ijo during a period of severe geopolitical and monetary crisis. Gold effortlessly smashed past $10 per ounce for the first time in history. Then it blew straight through $10. And in early January of Ardenarwu, it briefly touched an unbelievable high of over $10 per ounce, even after a standard technical pullback from that peak. It is currently consolidating in a strong range between $10 and $10 per ounce. Institutional analysts at JP Morgan are officially forecasting that gold will average a historic $10 per ounce by the final quarter of Ardenarwu, with long-term macroeconomic models pointing to $10 as a highly probable baseline reality. Why is this happening? Because we have multiple massive global forces all converging on the exact same asset at the exact same time. First and foremost, global central banks are accumulating physical gold at the fastest pace recorded since the post-World War II era. We are talking about over 2 metric tons of physical gold systematically purchased in the last 12 months alone by non-Western central banks. Nations like China, Turkey, India, and the wealthy Gulf states are quietly, steadily, and relentlessly liquidating their massive holdings of U.S. Treasury debt and rotating that capital directly into physical gold bars. Look at the undeniable structural trend. The US dollar's total share of global sovereign reserves has steadily deteriorated from a dominant 5% in Ijo down to a modern low of roughly 5% to 5% by Ardenarwu. Sovereign nations are actively diversifying their national reserves away from the dollar system, and gold is the primary beneficiary of that de-dollarization trend. Second, the physical